Good morning. Thanks very much for joining us today for our 2025 Corporate Disclosure webinar. My name is Denise Weirs. I am the Director of Corporate Finance here at the Alberta Securities Commission. This morning, you're going to hear from a number of members of our Corporate Disclosure and Financial Analysis department within corporate finance. They're all CPAs, CAs here, and they're responsible for conducting the disclosure reviews of the disclosure made by reporting issuers for which the Alberta Securities Commission is the principal regulator. So they're looking at prospectuses, continuous disclosure, and voluntary disclosures, such as information on websites. And so they're going to share some of their insights and tips for you this morning. This webinar follows from the publication in early December of the Corporate Disclosure Review Report. If you haven't seen it and you're interested, it's available on our website in the Reports and Publications section. As well, we are hosting another webinar next week on the 22nd, and that is from our energy group, and it is a result of their reviews of oil and gas reserves and resources disclosure. So if you're interested in that and haven't signed up, please do so. You can do that on our website as well. We're going to have a presentation. It'll be about an hour, and then we'll take questions at the end. We're using Slido today to do the questions, so you don't have to download anything. You should be able to just enter your questions, and we'll try to answer all of the questions. If they're particularly challenging, maybe take more time, or really specific to your particular company, we may take those offline, but otherwise we'll try to answer all of those at the end of the presentation. I think that's all I'm going to mention. I'll just do the land acknowledgement, and then I will pass it over to Jennifer to give you an overview of what we're going to be talking about today and to kick us off. We are physically situated in Calgary, the Alberta Securities Commission, but of course we represent the province in total. So we acknowledge that Alberta is the traditional and ancestral territory of many Indigenous people, including the Métis people, the Inuit, and the First Nations, presently subject to Treaties 6, 7, and 8. We acknowledge and respect the histories, the languages, and cultures of all of the First Peoples of Canada who have lived and cared for these lands for generations and whose presence continues to enrich our community. So with that, I will turn it over to Jennifer.
Thanks, Denise, and good morning, everyone. My name is Jennifer Pearson, and I'm joined by my colleagues Roger Prasad, Chris Andrews, Rebecca Moen, Nicole Law, Oliver Luchin, and Anthony Potter. We are members of the Corporate Disclosure and Financial Analysis team in the Corporate Finance Division, and we conduct disclosure reviews, including continuous disclosure reviews, as part of the Alberta Securities Commission's Disclosure Review Program. Today's discussion is intended to highlight, based on our reviews, areas where disclosure regarding mergers and acquisitions could be improved, draw attention to disclosure issues concerning share-based payments and acquisitions, provide guidance around avoiding selective disclosure, outline cybersecurity disclosure requirements, explain the listed issuer financing exemption, and provide certain corporate finance regulatory updates. Before we get started, if you could note the following disclaimers. This session is eligible for Certified Professional Development, also referred to as CPD hours for CPAs. Other professional bodies may also accept this session for CPD credit. Please follow up with your relevant institution to make this determination. During the session, 2 codes will be displayed. To receive confirmation of your attendance at this session, you must enter the codes presented in the survey at the end of the presentation. Half an hour of CPD credit will be provided for each correct code, so please ensure that you write down the codes as they are displayed. As our first topic this morning, my colleague Roger Prasad and I are going to discuss some of the disclosure requirements and best practices that reporting issuers should be mindful of when they are involved in mergers and acquisitions. We've noted in our continuous disclosure reviews that sometimes documents or disclosures are missing, and there are areas where disclosure could generally be improved. As such, we'll focus our discussion on these areas. They include voluntary disclosures, balanced disclosure, forward-looking information or FLI, non-GAAP measures or NGMs, material change reports, management discussion and analysis or MD&A disclosure requirements, related party transactions, business acquisition reports, material contracts, and notices. Reporting issuers often voluntarily disclose information about mergers and acquisitions in investor presentations on their website and in social media, but sometimes fail to include the information in their continuous disclosure filed on SEDAR+. ASC staff will generally expect any material information that is disclosed in these other sources to also be included in the reporting issuer's regulatory filings, such as the MD&A, financial statements, information circular, news releases, and or annual information form as applicable. Failure to do so could result in an incomplete and inaccurate continuous disclosure record and the selective disclosure of information. Rebecca Moen will address selective disclosure in more detail later in the presentation. With regards to balanced disclosure, reporting issuers should ensure that disclosure regarding an acquisition, whether in required continuous disclosure documents or in voluntary disclosure, does not focus solely or principally on positive aspects while de-emphasizing risks and less favorable aspects of the transaction. Unbalanced disclosure can be overly promotional and or misleading and could undermine the integrity of the capital markets. Reporting issuers should be aware of general prohibitions against making false or misleading statements that would be expected to have a significant effect on the price or value of an issuer's securities. Guidance regarding balanced and selective disclosure can be found in CSA Staff Notice 51-356, Problematic Promotional Activities by Issuers, and CSA Staff Notice 51-348, Staff's Review of Social Media Used by Reporting Issuers. When reporting issuers are party to an acquisition, we often see them include pro forma financial information or financial projections, including certain key performance indicators in news releases or other documents. These disclosures often constitute forward-looking information and are also often non-GAAP measures. Reporting issuers should be aware that when forward-looking information and non-GAAP measures are provided, whether in required or voluntary filings, specific disclosures are required. The disclosure requirements regarding non-GAAP measures are described in National Instrument 52-112, and the required disclosures regarding forward-looking information are outlined in Parts 4A and 4B of National Instrument 51-102. With regards to forward-looking information, it should be noted that reporting issuers must have a reasonable basis for the forward-looking information and must state the material, factors, and assumptions used to develop it. Reporting issuers also have an obligation to update previously disclosed forward-looking information.
An M&A transaction may be considered a material change that requires both the issuance of a news release and the filing of a material change report. A material change report must be filed as soon as possible and in any event within 10 days of the date in which the material change occurs. Additional guidance on determining if an event or transaction is material can be found in Part 4 of National Policy 51-201 Disclosure Standards. I would like to highlight that the material change report includes a requirement to provide disclosure of restructuring transactions. This is required by Section 5.2 of the form and applies to a material change report filed in respect of the closing of a restructuring transaction under which securities are to be changed, exchanged, issued, or distributed. This requirement will apply unless, if in respect of the transaction, the reporting issuer sent an information circular to the security holders or filed a prospectus or a securities exchange takeover bid circular disclosing the restructuring transaction. The disclosure required in the material change report is the same disclosure required by Section 14.2 of Form 51-102 F5 Information Circular. That is, prospectus level disclosure for each entity that resulted from the restructuring transaction, assuming that the reporting issuer has an interest in one of those entities. Reporting issuers can satisfy this requirement by incorporating the information by reference from another document, such as a filing statement, for example. It's important to remember that there are MD&A disclosure requirements when a reporting issuer is contemplating or has completed an M&A transaction. When the board of directors or senior management of a reporting issuer believe that it is probable that the reporting issuer will proceed with a proposed asset or business acquisition or disposition, the reporting issuer is required to disclose the expected effect of the proposed transaction on its financial condition, financial performance, and cash flows in their MD&A. The status of any required shareholder or regulatory approvals should also be provided. Staff note that this is a recurring deficiency. The status of these approvals is usually a material consideration, so it's important that this information be provided so investors have relevant information with which to make investment decisions. Likewise, after the completion of any material acquisition, disposition, or similar event, reporting issuers are required to provide an analysis of the effect of the transaction on their continuing operations, financial condition, financial performance, and cash flows. In preparing this document, it's important to include both qualitative and quantitative analysis of the impact of the reporting on the reporting issuer. This will allow investors to understand what proportion of a reporting issuer's growth or contraction was attributed to the acquisition or disposition as opposed to continuing operations. Related party transactions are potentially more risky than arm's length transactions, and that is why disclosure of this information is considered material information for investors. Good disclosure identifies the related party and the relationships between the related party and the issuer, discusses the related party transaction, the business purpose, provides a description of any ongoing contractual or other commitments, and states the recorded amount of the transaction and the measurement basis used to determine the amount. Related party disclosures are required under IFRS in the financial statements. And in addition, the MD&A requires a discussion of the business purpose of the transactions with related parties. For example, the business purpose for consulting fees paid to related parties must be explained in the MD&A. Additionally, the MD&A requires that each related person or entity be specifically identified and named in the disclosure. Reporting issuers should also consider whether any related party transactions fall within the scope of MI 61-101, protection of minority security holders in special transactions. If so, this could introduce additional disclosure requirements in the material change report and/or information circular, formal valuation reports, or minority shareholder approvals.
Generally, reporting issuers will be required to file a business acquisition report, or BAR, on SEDAR+ if they complete an acquisition that is determined to be significant. Reporting issuers that are planning to complete an acquisition should review the BAR requirements in Part 8 of National Instrument 50-10102 for the significance test that must be applied, along with other important BAR requirements. We often note that BARs are not filed when they are required to be, or that BARs do not include all of the required disclosure, including correct annual, interim, and pro forma financial statements. We remind reporting issuers to carefully review the requirements and ensure that they are applied correctly. It is also important to note that what constitutes a business for purposes of IFRS and securities legislation may differ. It is the securities legislation definition that is relevant in determining whether a BAR is required. We generally consider that a separate entity, a subsidiary, or a division is a business, and in certain circumstances, a smaller component of a company may also be a business, whether or not the business previously prepared financial statements. An M&A transaction may involve new material contracts being entered into, such as purchase and sale agreements and related ancillary agreements. For example, operating or license agreements. We encourage issuers to review all agreements to determine whether they are material contracts that must be filed. Something else to keep in mind is to ensure all relevant notices have been filed. For example, notices regarding a change in corporate structure, change in year end, and/or a change in auditor may be required. That concludes our presentation on M&A disclosures. Now we'll pass it over to Chris.
Thank you and good morning. I am Chris Andrews, a Senior Securities Analyst in the Corporate Finance Division of the Alberta Securities Commission. Today we'll be covering acquisitions involving share-based payments and certain deficiencies we've been noticing where required disclosures are not being made, and when we look further into the acquisition, it appears that the consideration being paid is not supported by the value of the asset or business being acquired. We have noted that with these problematic transactions, the following characteristics often appear to be present. The company being acquired is a private company or asset held by a private company with a limited operating history. The issuer pays for the acquisition by issuing a significant number of its own securities. There is limited financial information disclosed in the news release about the company or asset to be acquired. There is limited or no disclosure regarding what the excess of the consideration paid over the net identifiable assets acquired represents, nor why management is willing to pay that excess. Vendors are often related parties and/or related entities, such as close family members and business associates, or companies controlled by directors and officers of the reporting issuer. We often see limited subsequent disclosure about the acquisition, followed by the acquisition being written off, often within a short time period. This may indicate that the issuer significantly overpaid for the acquired company or asset and has potentially issued shares without consideration. Acquisitions of this nature impact the capital market and cause harm. A lack of appropriate disclosure regarding the acquisition means transactions are not transparent, as investors often do not have timely information to evaluate the proposed acquisition, and the transactions result in asymmetric information in the markets, where the owners of the acquired company have information about the value of the target or lack thereof, while other investors are left in the dark until the required filings are made, such as a business acquisition report, known as a BAR, or audited annual financial statements. Further, these acquisitions can harm the fairness of the market by transferring significant value from the existing investors to the new investors, who receive their securities at substantially below fair market value. These transactions may also raise corporate law compliance considerations. As an example, the reporting issuer, referred to as ABC Company, announced an agreement to acquire 100% of a private company for 15 million of its own shares at an approximate value of $5 million. The private company is majority owned by the CEO of the reporting issuer and holds intellectual property assets. However, it acquired the assets 21 days prior for $75,000 in cash and 100,000 private company shares, which appear to have nominal value. The issuer had a calculation valuation report prepared to support the transaction, which assumed that the issuer would generate $22 million of revenue in year one. It was noted that no patents had been issued and the technology in question was under development. In this scenario, the likelihood of generating revenue in year one appears to be remote, as no patents have been issued and the technology has not been developed, calling into question the reliability of the valuation report. A BAR was not filed to support the acquisition. Subsequently, when the audited annual financial statements were filed, it was determined that the issuer recorded the acquisition by reference to the fair value of its securities issued and not the fair value of the private company acquired. Section 13 of IFRS 2, share-based payment, includes the rebuttable presumption that the fair value of goods and services received can be estimated reliably, and that only in rare cases an entity can rebut this presumption and record the transaction by reference to the fair value of the equity instruments granted. There was a lack of disclosure in the audited annual financial statements, as the issuer did not provide the disclosure required by Section 46 through 49 of IFRS 2 to support its rebutted presumption. Mainly, not disclosing the fact it had rebutted the presumption and not providing information as to why the private company's fair value could not be estimated reliably, and why, in this rare case, it recorded the transaction based on the fair value of its own securities issued. As set out in CSA Staff Notice 51-365, staff are likely to have concerns when there is a significant difference between the fair value of the consideration paid and what would reasonably seem to be the fair value of the net assets acquired. As previously mentioned by Roger, when an issuer acquires an asset or a business, certain disclosures are required by IFRS in an issuer's financial statements, and additional disclosures are required in an issuer's management's discussion and analysis, or MD&A. When preparing their financial statements, issuers will need to consider business combination disclosure requirements under paragraphs 59 and B64 to B67 in IFRS 3, business combinations, which includes disclosure of the primary reasons for the acquisition, the amounts recognized as of the acquisition date for each major class of assets acquired and liabilities assumed, a qualitative description of the factors that make up goodwill, if recorded, pursuant to the requirements of Section B64E in IFRS 3. Further, intangible asset recognition criteria must be met, or acquisition costs must be expensed in accordance with the requirements in IAS 38, intangible assets. And when intangible asset recognition criteria is met, the issuer is required to provide all of the related disclosure specified by paragraphs 118 through 128 of IAS 38, including any impairment losses recognized during the period. For goodwill and intangible asset impairment losses, IAS 36, impairment of assets, requires that the assessment be based on reasonable and supportable assumptions, and disclosure is required to be provided in accordance with paragraphs 126 through 137 in IAS 36, including disclosure of the events and circumstances that led to the recognition of the impairment loss. An issuer recording significant transactional goodwill or intangible assets is expected to explain in the MD&A why management has decided to pay a significant amount over the fair value of the net identifiable assets acquired. When preparing MD&A disclosure, issuers will need to include a discussion of the details and specifics of the intangible assets when recognized, pursuant to Form 51102F1, Management's Discussion and Analysis. This disclosure is provided pursuant to Part 1D, Items 1.2, 1.3 Sub 2, and 1.4J. If the issuer is a venture issuer without significant revenue, then must also disclose a breakdown of the material components of the intangible assets pursuant to Section 5.3 of National Instrument 51102 Continuous Disclosure Obligations. And an issuer recording significant impairment of goodwill or intangibles in the same reporting period or in the same fiscal year as the transaction must disclose the circumstances leading to the impairment loss and any changes from the methodologies, key inputs, or assumptions utilized in the purchase price allocation or impairment analysis at the acquisition date. This disclosure is required by items 1.2, 1.3 sub 2, and 1.4J of Form 51102F1. Staff may also raise comments during either our continuous disclosure or prospectus reviews, where the fair value of the consideration paid compared to the fair value of the net assets acquired appears unreasonable. Where issuers have recorded transactions by reference to the fair value of the equity instruments granted and rebutted the presumption in Section 13 of IFRS 2, which is that the fair value of goods and services received can be estimated reliably, staff remind issuers that they are specifically required under Section 49 of IFRS 2 to disclose this fact and give an explanation as to why the goods and services received could not be estimated reliably. Where the explanation is missing or incomplete, staff may request issuers to provide further analysis to support their assessment. Section 46 through 49 of IFRS 2 requires an issuer to provide disclosure that allows users to understand how fair value was determined. If this is not provided in an issuer's audited annual financial statements, staff will generally raise comments and require issuers to clarify their disclosure. We note that in some cases, issuers disclose that a valuation report was obtained to support the fair value of the transaction. If a valuation report is to be disclosed, issuers should ensure that the valuation report is appropriate for the valuation subject or target, and ultimately, the purpose and audience of the report. We have encountered situations where the assumptions used in a valuation report are unsupported or inconsistent with the terms and conditions of the issuer's agreements. In such cases, it would not be reasonable to rely on the report to support fair value. In our reviews, staff may request a copy of the issuer's valuation report and also request supporting documents and agreements from the issuer to corroborate management assumptions for reasonableness. Where audited annual financial statements for the target company are required, such as when a BAR or prospectus level disclosure is required to be filed to support an acquisition, staff may review the target company financial statements to help assess the fair value of the net assets acquired in relation to the consideration paid by the issuer for reasonableness. We have also encountered instances where the description of the business in the target company's audited annual financial statements appears promotional and not representative of the current nature of the entity's operations and its principal activities. Staff note that in many of the acquisitions where disclosure is insufficient, the target company generally does not have material operating assets and often only records professional fees as an expense and appears to be an inactive business. We would generally expect that the target company should be disclosed as such, as at the date of the auditor's report, according to the requirements in Section 138 of IAS 1, Presentation of Financial Statements. It would not generally be appropriate to describe the target company's business based on the future desired state of operations and activities to be undertaken post-transaction. Lastly, for those issuers that have completed or are planning to complete an acquisition and expect to then file a prospectus, we remind them that paragraph 120 sub 2B of the Securities Act provides that the executive director must not issue a receipt for a prospectus where unconscionable consideration has been paid or given, or is intended to be paid or given for the acquisition of the property. Staff will raise comments and we will not be in a position to recommend a receipt if it appears an unconscionable consideration has or is to be paid. That concludes this portion of the webinar. Thank you for your time. I will now pass it over to Becky Moen to discuss selective disclosure matters.
Thanks, Chris. Good morning, everyone. Before we continue on to the next subject in our presentation, I want to pause for a moment to draw your attention to the first CBD learning code that is presented on the screen. The word to remember is disclosure. As Jennifer mentioned, you will need to enter this word in the survey at the end of the presentation to get your CBD credit. So again, I encourage everyone to jot down the word disclosure. Moving on. Today, I'm going to speak on the topic of selective disclosure, as this is an area where we're continuing to see a number of issues come up in our continuous disclosure reviews. This topic has been and continues to be a focus area for our team, as one of the key principles underpinning a fair and efficient capital market is that all investors have equal access to material information that could influence their investment decisions. Therefore, we believe it's really important to consider any sources of information asymmetry. So to begin, let's clarify what we mean when we say selective disclosure. Securities legislation prohibits a reporting issuer and any person or company in a special relationship with that reporting issuer from informing, other than in the necessary course of business, anyone of a material fact or a material change before that information has been generally disclosed. This is more commonly known as tipping. For example, this could include material information shared through a more traditional source, such as a corporate presentation or a sustainability report, or through less traditional sources, such as social media websites like TikTok, YouTube, X, or LinkedIn. Or we've also seen issuers utilize blogs and investor newsletters, either authored by the company directly, or in some cases by an investor relations firm on their behalf. For clarity, we're not prohibiting or even discouraging companies from using these methods to engage with their stakeholders. However, to avoid selective disclosure, reporting issuers do need to have practices in place to ensure that any material information that is disclosed through these sources is also generally disclosed to the market. This could include establishing appropriate board and senior officer oversight over oral, written, and electronic disclosure, as well as ensuring that issuers are not participating in chat rooms or bulletin boards, or they have adequate procedures in place to prevent selective disclosure. Next, we'll walk through a couple of examples of the types of issues we see before concluding with a few best practices that issuers can implement to avoid inadvertent selective disclosure. The first example looks at the timing of disclosure. In this scenario presented on the slide, the company has a free newsletter through which they send their monthly corporate updates to their subscribers. Interested parties can sign up to receive this newsletter on their website at no charge. As you can see, the company first announced via this newsletter that they were in discussions with a counterparty to dispose of one of their major lines of business. This was the first time they released this news. They then filed their Q2 interim financial statements and MD&A, which made no mention of this disposition. As the timeline shows, it wasn't until a few weeks later, once the actual agreement was signed, that they filed a news release and material change report disclosing this material information. This delay in disclosure resulted in information asymmetry between investors that had received the newsletter and those that had not. In this scenario, a subscriber-based newsletter would not meet the standard of generally disclosed, as it would not provide the information to the marketplace generally. Also, as a reminder, newsletter aside, we remind reporting issuers that when determining whether or not there is an obligation to issue a material change news release, the definition of a material change includes a decision by the board of directors to implement a change, or even a decision by senior management where confirmation of the board of directors is probable. This may happen even before the directors approve it, if it is probable that they will do so. The next example illustrates the discrepancies we see between the depth of disclosure provided in continuous disclosure filings versus that which is disclosed in voluntary filings. In this example, an oil and gas issuer completed a significant acquisition of a property and filed a material change report announcing the acquisition. However, the details provided in the material change report were sparse and limited to the acquisition date, consideration, and a brief description of the property acquired. Shortly after, the issuer posted a corporate presentation to their website, and that highlighted the acquisition and how it would be transformational to the company. The corporate presentation contained all the same information as material change report. However, it also included additional material information, such as who the counterparty was and what their history was with the project, historical reserve information, as well as projected production and revenue numbers, and future development plans for the property. This is problematic for two reasons. First, the issuer failed to comply with the requirements for disclosing a material change. As Section 5 of Form 51102 F3 Material Change Reports requires reporting issuers to provide sufficient disclosure to enable a reader to appreciate the significance and impact of the material change without having to refer to other material. Second, posting the corporate presentation on a company's website will not generally meet the standard of material information being generally disclosed, as the information is not pushed out to investors, and as such, it would provide investors who viewed the presentation with information about the acquisition that other investors do not have, and result in selective disclosure that contravenes the prohibition on tipping. Now that we've highlighted some of the issues that may arise when information is selectively disclosed, I'll conclude by discussing a few best practice tips that reporting issuers can implement. While securities legislation does not define the term generally disclosed, National Policy 51201 Disclosure Standards discusses a concept which has been reinforced by court and tribunal decisions over the years. The policy states that information is generally disclosed when it is communicated in a way that it effectively reaches the marketplace and gives investors a reasonable amount of time to analyze the information. Securities legislation does not mandate a specific method for dissemination, as we recognize that issuers need flexibility in crafting a disclosure model. However, National Policy 51201 does include best practices. These include issuing a news release via widely distributed news or wire service and filing it on SEDAR+ concurrently. And in situations where it is appropriate, following this up by holding an open and accessible conference call to discuss the contents of the release. This approach ensures that information reaches the market effectively and reduces the risk of unintentional selective disclosure. In addition, we encourage issuers to establish policies and procedures that provide effective controls over how and when material information is released. For example, to prevent inappropriate use of confidential material information, issuers should consider limiting dissemination of information and using confidentiality agreements with any parties with whom information is permitted to be shared. And to avoid breaching the tipping prohibitions, if material information is inadvertently provided to a select group, unless a necessary course of business exception applies, the issuer may need to promptly make general disclosure to the marketplace. We encourage issuers to review National Policy 51201 and to seek legal advice to ensure they implement appropriate policies and procedures. I also want to note that we are seeing an increasing number of issuers who are utilizing investor relations services as part of their communication strategy. We remind issuers that it is important that they have policies and procedures in place to address this relationship and to ensure that information being released by or through agents on behalf of the issuer complies with securities laws, as well as monitor any disclosures being made on their behalf, as issuers will generally be considered responsible for this disclosure. In addition, we remind issuers that Section 103.1 of the Securities Act, Alberta, requires that all disclosure made by investor relation firms, both written and verbal, must clearly state that it was made on behalf of the issuer. I'll conclude this section by reminding everyone that we all have a role to play in maintaining trust and transparency in the capital markets. As markets continue to evolve and the channels for corporate communication expand, it is critical that companies recognize the importance of providing all their investors with equal access to material information to enable them to make informed investment decisions. I'll now pass it on to Nicole for the next section.
Thanks, Becky. The cybersecurity landscape in Canada is continuously evolving, with cybersecurity incidents becoming more frequent and costly to issuers. Cyber incidents can impact a company's day-to-day operations, result in a loss of assets or increased costs, or expose sensitive information. In some cases, there may be a loss of customer or employee personal information, which could cause long-lasting reputational harm. All organizations are vulnerable to a cyber attack, and while in many instances organizations are being targeted for their technical data and intellectual property, motivation for these attacks can vary. As a result, the occurrence of cyber attacks have been described as not a matter of if, but when. According to a recent report published by the Canadian Centre for Cybersecurity, the threat from fraud and scams continues to grow every year in Canada, with fraud losses up nearly 50% from 2021 through 2023 to $567 million in 2023. In October 2024, the Government of Canada conducted a survey of IT and cybersecurity professionals that revealed that 44% of respondents reported that their organization experienced a cyber attack in the past year. The results showed that all organizations are vulnerable to a cyber attack, with respondents from all sectors being affected. Considering these frightening statistics, organizations are having to adapt by ensuring that they have the necessary internal procedures in place to identify, protect, detect, respond, and recover from a cybersecurity incident. Securities legislation in Canada requires disclosure of certain cybersecurity-related information in an issuer's regulatory filings, if such information is material. The disclosure requirements can be categorized into 4 categories: risk factors, risk management and oversight, material cyber incidents, and other matters. First, we would like to talk about risk factor disclosures. Risk factors that have specifically impacted an issuer or are reasonably likely to affect the issuer in the future must be disclosed in the MD&A and, if applicable, the annual information form. When discussing risk factors, the disclosure should be specific to the issuer and avoid boilerplate wording. When considering cybersecurity risk factors, issuers should think about the reasons they may be exposed to a cybersecurity attack or breach, the source and nature of the risks, the potential consequences of a cybersecurity incident, the adequacy of preventative measures, as well as the consideration of prior material cybersecurity incidents and their effects on the issuer's cybersecurity risk. While recently new cybersecurity acts were proposed under Federal Bill C-26 to protect vital services and systems that are critical to Canada, including telecommunication services, interprovincial or international pipeline and power line systems, nuclear energy systems, transportation systems, banking systems, and clearing and settlement systems, all reporting issuers should be considering their unique circumstances when assessing risk. Issuers should also consider how they mitigate these risks, including whether and to what extent the issuer is reliant on management and third-party experts for their cybersecurity strategy or to remediate prior or future cyber attacks. Here are some examples of potential cybersecurity risk factors. We commonly see operational risk, reputational risk, and loss of information being disclosed by issuers across all industries. In addition to looking internally, issuers should assess the inherent vulnerabilities associated with third-party systems, which may be a source of cybersecurity risk. Cyber threat actors are increasingly targeting third-party systems such as software tools, services, and vendor systems instead of directly targeting organizations. So it is important that issuers consider third-party service providers in their risk assessment. Part of cybersecurity risk mitigation is risk management and oversight. In addition to risk factors, issuers may wish to disclose their governance with respect to risk mitigation strategy. Typically, we see the audit committee being identified, but we also see some issuers identifying the board of directors or the risk committee. Additionally, issuers may wish to disclose their cybersecurity framework that is designed to help management and mitigate cybersecurity risks associated with their information and technology systems. For example, the National Institute of Standards and Technology's cybersecurity framework in the US. We expect that issuers who are required to establish and maintain disclosure controls and procedures under National Instrument 52109 apply such controls to detect cybersecurity incidents in order to ensure these incidents are communicated to management and a decision regarding whether and what to report is made in a timely manner. Examples of some cybersecurity controls that issuers should consider are a cyber incident recovery plan, which outlines the issuer's strategy for responding to a cyber attack. This includes identifying who is responsible for handling the incident and overseeing IT security. Controls to prevent unauthorized access to an issuer's information, devices, or networks, and ensuring access to portals for clients and third parties is secure. In considering whether and when to disclose a cybersecurity incident, the issuer must first assess the impact of the incident to determine whether it is a material fact or material change that requires disclosure in accordance with securities legislation. Stock exchange policies also impose supplementary obligations to provide timely disclosure of material information. The determination of what is material is objective and involves judgment. There is no simple bright line test or uniform quantitative threshold. We generally consider information to be material if a reasonable investor's decision whether or not to buy, sell, or hold securities of the issuer would likely be influenced or changed if the information was omitted or misstated. The determination of whether an incident is material evolves throughout the various phases of investigating a cybersecurity attack. An investigation into a cyber attack can take months, with the full impact and cost increasing over time. As such, the materiality of a cyber incident should be continuously assessed. From a disclosure perspective, we have observed issuers that have announced a cyber incident that they believe was contained or impacted only a subset of assets, only to disclose at a later date that the impact of the cyber attack or potential data loss was significantly greater than initially disclosed. If an issuer concludes that the cyber incident is a material change, the issuer should immediately issue and file a news release authorized by an executive officer, disclosing the nature and substance of the change. In addition, the issuers must also file a material change report with respect to the material change as soon as practical and in any event within 10 days of the date on which the change occurs. Additionally, if the cybersecurity incident is reasonably likely to have a material impact on the operations, including qualitative or quantitative impacts, issuers should describe the material impacts or likely material impacts in their MD&A and, if applicable, their AIF. Consider the impact to operations related to an outage of systems, reputational harm, and customer or affiliate relationships. Lastly, we understand that in certain circumstances, legislation may require issuers to report or notify regulatory agencies and individuals of cybersecurity breaches, but these obligations are different than those provided by securities legislation in Canada. There may also be a legal obligation to report the cyber incident to law enforcement under Canada data protection and privacy laws, such as the Personal Information Protection and Electronic Documents Act. If the cyber incident is not a material event, it is up to the issuer's discretion to file a news release detailing the incident. When preparing a news release, we caution issuers to ensure that you consider both the short and long-term impacts that may be associated with the cybersecurity incident and ensure that appropriate updates are provided as matters evolve and become material. Lastly, issuers should be aware that their cybersecurity disclosures may constitute forward-looking information or non-GAAP and other financial measures. For example, disclosing the forecasted revenue is expected to decrease by $1 million as a result of cyber incident would be a forward-looking statement. When an issuer discloses forward-looking information, it must comply with requirements set out in Part 4A, Part 4B, and Section 5.8 of National Instrument 51-102. Additionally, an issuer may adjust a non-GAAP and other financial measure for the impact of the cybersecurity incident. When an issuer discloses non-GAAP and other financial measures, it must comply with the disclosure requirements set out in National Instrument 52-112. While the instrument does not explicitly prohibit certain adjustments, issuers must not present or disclose financial measures that are inappropriate or misleading. For example, it may be misleading to include positive components like insurance proceeds, but exclude operating expenses included as a result of the cyber incident. Finally, I want to make you aware of specific rules that impact SEC issuers. On July 26, 2023, the U.S. Securities and Exchange Commissions adopted rules on cybersecurity, which require public companies subject to the Securities Exchange Act of 1934 to disclose material cybersecurity incidents on Form 8K and disclose material information regarding their cybersecurity risk management, strategy, and governance in their annual reports. Under the new rule, public companies are required by the SEC rules to report information regarding a material cybersecurity incident within 4 business days after the company determines that the incident was material, but not at the time of discovering the incident. Information to be disclosed in Form 8K includes a description of the material aspects of the nature, scope, and timing of the incident, as well as the material impact or reasonably likely material impact on the company, including its financial condition and results of operations. The SEC rule also requires public companies to describe in their annual reports their processes, if any, for assessing, identifying, and managing material risks from cybersecurity threats, as well as the material effects or reasonably likely material effects of risks from cybersecurity threats and previous cybersecurity incidents. Lastly, SEC issuers are required to describe the board of directors' oversight of risks from cybersecurity threats and management's role and expertise in assessing and managing material risks from cybersecurity threats. In summary, it is important that issuers understand their risks, resources, and planned response to a cybersecurity incident, as well as their respective disclosure requirements under securities legislation in Canada. We encourage issuers to discuss their processes and resources with their technology experts. For additional information on this topic, the CSA has published 2 staff notices on cybersecurity that can be found on the ASC's website, Staff Notice 11332 and Staff Notice 51347. I will now pass it over to Oliver.
Thank you, Nicole. Today I'll be walking you through the listed issuer financing exemption. The listed issuer financing exemption, or LIFE, is a new prospectus exemption set out in National Instrument 45106 Prospectus Exemptions. It provides a more efficient method of capital raising for reporting issuers that have filed all timely and periodic disclosure documents required under Canadian securities legislation. It was adopted by all CSA members and came into effect on November 21st, 2022. The exemption relies on the issuer's continuous disclosure record, as supplemented with a short offering document, and allows issuers to distribute freely tradable listed equity securities to the public. Issuers are limited to raising the greater of $5 million or 10% of the issuer's market capitalization to a maximum total dollar amount of $10 million, which makes it best suited for smaller issuers. LIFE has several key conditions an issuer must meet to qualify to be able to use the exemption. An issuer must have been a reporting issuer in Canada for at least 12 months prior to the news release announcing the offering, have a class of equity securities listed for trading on a Canadian stock exchange, have filed all periodic and timely disclosure documents, have active business operations, and its principal asset cannot be cash equivalents, nor can its exchange listing be a capital pool company. Reasonably expect to have available funds to meet all business objectives and liquidity requirements for 12 months after the offering, and the issuer cannot be an investment fund. The listed issuer financing exemption is only available for the distribution of equity securities and units consisting of listed equity securities and warrants convertible into listed equity securities. There are restrictions on what the financing can be used for. Proceeds cannot be used to fund a significant acquisition or restructuring transaction or any other transaction that requires security holder approval. The offering document must be prepared in accordance with Form 45106 F19. It's not subject to an advanced review and comment period like a prospectus. However, it may be reviewed by ASC staff to ensure the issuer is in compliance with the requirements of the exemption. If staff's review identifies material deficiency, the issuer may be required to file an amended offering document and remedy deficiencies such as the filing of unfiled documents. In our reviews, we've identified 3 key areas of deficiencies: issuers having insufficient funds, issuers exceeding the number of allowable securities that can be issued under LIFE, and problems with the dating of the certificate. One of the requirements under LIFE is that the issuer is required to have sufficient available funds to meet the issuer's business objectives and liquidity requirements for a period of 12 months after the offering closes. The issuer must ensure the minimum offering amount is such that, following the completion of the distribution, the issuer will have sufficient available funds to meet its business objectives and liquidity requirements for a period of 12 months. Items 8 and 9 of the form require the issuer to specify what the total available funds upon closing of the offering will be and how they will be used. In situations where there has been a significant decline in working capital since the most recently completed audited financial statements, that decline is required to be explained. Further, if the issuer's recently filed financial statements include a going concern note, that fact must be disclosed along with an explanation as to how this offering impacts the issuer's going concern. Staff may also review the issuer's continuous disclosure documents to assess whether the issuer satisfies this requirement and whether the disclosure in the offering document provides potential investors with sufficient information regarding the sufficiency of funds. CFA Staff Notice 45-330 is a Q&A of frequently asked questions regarding the use of life offering and should be consulted prior to drafting a life offering document. On this topic in particular, Comment 3 provides additional guidance as to what funds can be included in calculations under items 8 and 9. The next key area relates to ensuring the offering does not exceed the limit on the number of allowed securities to be issued under life. The distribution combined with other distributions under the life exemption during the 12 months preceding the date the offering was announced must not result in an increase of more than 50% of the issuer's outstanding securities, as stated by subparagraph 5A.2H of National Instrument 45-106. The assessment is to be made using the date that is 12 months before the date of the news release that announces the offering, not the actual date the offering was announced. And all distributions under life during that same 12-month period must be considered in this calculation. This will be an important distinction for issuers who will be using the exemption for a second and potentially third time. Another important factor to consider is that common shares issuable on exercise of warrants need to be included in the calculation. Referring again back to CSA Staff Notice 45-330, Comment 12 states that common shares that are issuable on exercise warrants must be included in the calculation of the 50% dilution limit. We've seen instances where warrants were not factored in and resulted in the offering amount needing to be amended. It's important to note that while the number of warrants are considered against the limit of total securities, proceeds obtained on exercise of warrants are not counted against the maximum allowable total proceeds under life. For details, see Comment 13 of the staff notice. A listed issuer financing document is considered a core document under the statutory secondary market civil liability provisions of applicable Canadian securities law, and as such, the issuer will be liable for purchasers under the life offering if there is a misrepresentation in the issuer's continuous disclosure documents. The CEO and CFO of the issuer are required to certify that the listed issuer financing document, together with certain filed documents, disclose all material facts relating to the securities distributed and do not contain a misrepresentation. We've noticed numerous offering documents that have been filed with an incorrect date in the certification, requiring a refiling of the document. The most common error is that the date included in the certification paragraph in item 15 of the form is the same date of the offering document itself within item 16. These dates should never be the same. The template guidance for the form requires the issuer to insert in the certification paragraph the date which is the earlier of the date that is 12 months before the date of the offering document and the date that is the issuer's most recent audited financial statements in which they were filed. While those three areas are the most common deficiencies and deserved a closer look and some clarifying discussions, certain other filing deficiencies are also quite common. The three primary documents to be filed under life include a news release announcing the offering and the location of the offering document, a completed Form 45-106 F19 listed issuer financing document, and a report on Form 45-106 F1 report of exempt distribution. Each of these documents are required to be filed in each of the jurisdictions where the offering takes place. It's also important to note that the completed form must be filed no later than 3 business days after the date of the form, and the report of exempt distribution is to be filed 10 days after the closing date of the offering. The most common issues we see relate to filings are as follows. The offering document is only filed in the jurisdiction where the issuer is a reporting issuer, rather than all the jurisdictions where the offering is taking place. For example, let's say we have an issuer who is a reporting issuer in Alberta, BC, and Ontario, and is conducting a life offering that is available to residents of every province and territory in Canada. We've seen instances where the offering document is only filed in Alberta, BC, and Ontario, rather than in every province and territory as required. The completed form is required to be made available on the issuer's website. Oftentimes, this is not done. And the news release announcing the offering is required to reference the offering document on the issuer's website, which again is often overlooked. This concludes the life portion of the presentation. Before we start our last section of the session, here is the second CPD learning code for you. The second code word is CDAR+. We'll leave this code up for a moment, and I'll pass it over to Anthony, who will provide our regulatory update.
Good morning. My name is Anthony Potter, and I am the manager for the Corporate Disclosure and Financial Analysis team. For today's regulatory update, here is a summary of the topics to be covered, the first of which is climate-related disclosure. In 2024, the Canadian Sustainability Standards Board, or CSSB, published for comment its proposed requirements for climate-related disclosure. Although the CSSB has published both Disclosure Standard 1 and 2, the CSA is only contemplating climate-related disclosure, not general sustainability disclosure. When adopted, the CSSB standards will be voluntary standards. The CSA has indicated that it would consider feedback received by the CSSB, as it may help inform the CSA's approach to climate-related disclosure. ASC staff have also engaged with Alberta market participants to understand their perspectives, and we continue to monitor international developments, including those in the United States, as well as consider the close connection between the Canadian and US capital markets and the needs and capabilities of Canadian issuers. Turning to diversity disclosure. In general terms, changes to current corporate governance disclosures were proposed to contemplate not just representation of women, but broader diversity characteristics on the board and in executive officer positions. This involved many stakeholder consultations as the project evolved. The CSA has reviewed the comment letters received, and a harmonized national disclosure framework is expected. Moving to the well-known seasoned issuer or WIXI regime. The WIXI regime permits large, well-known issuers with established continuous disclosure records to file shelf prospectuses qualifying an unlimited amount of securities, which are not subject to Securities Commission review. The blanket order creating the regime has been very well received, and many Alberta issuers eligible to use it are doing so. In addition, comments on a proposal to implement a permanent regime were generally supportive, and amendments to address the comments and implement a permanent WIXI regime are currently being finalized. Like WIXI, Access Equals Delivery is one of several initiatives aimed at reducing regulatory burden. Under an electronic access model, it was proposed that providing access to documents and alerting investors that they were available would have constituted delivery of the documents. The substance and purpose of the proposed amendments was to modernize the way information is communicated to investors and recognize that investors are increasingly consuming information electronically. With respect to prospectus documents, the proposed access model was generally well received, and new rules came into effect in April 2024. Comments, however, suggested that more work was required to develop a successful access model for continuous disclosure documents. Specifically, there were concerns of potential negative effects on retail investors, lack of meaningful notice of the availability and/or actual delivery of a document, and investors having to take action to access information. In November 2024, the CSA republished for comment proposed amendments to implement an access model for continuous disclosure documents. The proposal would allow investors to sign up to receive an email notification through CDAR+ of the filing of documents, but allow investors to continue to request or provide standing instructions to receive the documents in paper or electronic form. The comment period will end on February 17th, 2025. Another project to reduce regulatory burden, streamlining of annual and interim continuous disclosure obligations, was proposed in 2021. The proposed amendments to National Instrument 51-102 would combine the financial statements, AIF if any, and MD&A into a single annual or interim disclosure statement as applicable, and eliminate overlap and duplication in the disclosure contained in these documents. At present, these amendments remain on hold until the access equals delivery amendments are complete. Moving to investment funds. In March 2025, new rules will become effective that allow an investment fund in continuous distribution to file a new prospectus every 2 years. Regarding continuous disclosure requirements, there are also proposed amendments to replace the existing annual and interim management report of fund performance with a new annual and interim fund report, and also eliminate some class or series level disclosure from investment fund financial statements that are not otherwise required by IFRS. And last, an access model for delivering financial statements and report of fund performance, or fund report, continues to be evaluated. Finally, just a few comments with respect to IFRS 18. In April 2024, the International Accounting Standards Board issued IFRS 18 Presentation and Disclosure in Financial Statements, effective for annual reporting periods beginning on or after January 1, 2027, with earlier adoption permitted. I'm not going to go into detail regarding the new standard, other than to say IFRS 18 introduces the concept of management-defined performance measures, and these have traditionally been considered non-GAAP financial measures disclosed outside of the financial statements. The CSA is assessing the implications of IFRS 18, and we expect to update National Instrument 52-112 to ensure that all financial measures traditionally considered non-GAAP continue to be regulated under 52-112 when disclosed outside the financial statements. I believe that takes us to the Q&A session.
Okay, welcome back. We're gonna switch gears now and move into our Q&A session. So if you got a question and you haven't entered it yet, please do so. Give people a couple minutes to do that. Just while we're waiting, Jennifer, I have a question for you. And you talked about the requirements for material change report in respect of a restructuring transaction. That has the concept of a restructuring transaction is a defined term. Could you just maybe elaborate on that a little bit? What are we talking about when we say restructuring transaction?
For sure. Thanks, Denise. Well, as you mentioned, a restructuring transaction is defined in National Instrument 51-102. It could involve sorry if I could speak. It could be a reverse takeover, an amalgamation, merger, arrangement, reorganization, or any transaction similar to these. And it generally results in new security holders or a combination of persons or companies owning or being able to materially affect control of the issuer. As mentioned in the presentation, if a restructuring transaction takes place and the issuer has not filed a related prospectus, takeover bid circular, or information circular, prospectus level disclosure for each entity that resulted from the restructuring transaction must be included in the material change report.
Okay, thanks for that. All right, we've got a question here about a cybersecurity reporting. So Nicole, you've kind of been leading our efforts in looking at what's happened in the US with cybersecurity disclosure and then our disclosure review. Do you want to take this one after a cybersecurity incident? When do we need to report it and what do we have to disclose?
Yeah, so a cybersecurity incident, it may not immediately be detected. So when it is first detected, and throughout the entire time that the company is investigating it, you should continuously assess the materiality of the incident. And then if you conclude that it was a material change, then you need to immediately issue and file a news release. And then within 10 days, you need to file a material change report. If you conclude that there was not a material change, but it was an undisclosed material fact, in order to avoid selective disclosure, ensure that there's adequate precautions that are in place to take the information, make sure it hasn't been leaked out, and consider that everything is being disclosed. As to what needs to be disclosed, that depends on the circumstances of the incident, but it might be appropriate to consider and provide visibility as to the anticipated impact and the cost of the incident.
Thanks for that. Okay, I think the next question will I'll direct to Anthony. Anthony, there's a question here that says the corporate finance disclosure report indicates that 79% of the reviews resulted in prospective changes being suggested, and that this percentage seems quite high considering the people involved are educated, talented individuals. So what does this rate mean to us, and how can we reduce it?
Sure, yeah, it is certainly a high number. And I guess there could be a number of factors at play. So for example, maybe our review is looking at an emerging issue or a complex accounting issue. It could also just be a matter of inadvertently something is missing from an issuer's disclosure, and we're just asking for that to be corrected. So it's really hard to say. But our hope is ultimately through our comment letter process and webinars and other presentations that number can come down.
Thanks. Let's see here. I think, Becky, this one might be for you. Why are regulators looking at information filed outside of CDAR Plus? Isn't this voluntary disclosure?
Yeah, I can try and answer that one. I think this one's a good question because I do think it highlights a common misconception that might exist in the marketplace. So when we're reviewing documents or presentations or things that are kind of outside the quote unquote scope of the continuous disclosure regime, we're not reviewing for compliance with any particular form per se. Rather, we're just reviewing for consistency, like with what the issuer has said in their continuous disclosure documents and checking that that's been complied with. So just like a common example, like I like to say here is, if we're looking at a corporate presentation, an issuer is talking about a material change, then we see that a material change report hasn't been filed. That would signal for us that they haven't complied with their CD obligations. And then I guess maybe just to add to that too, there are some concepts that do apply more broadly. For example, forward-looking information. You are required to comply with the forward-looking information disclosure requirements, not only in your CD documents, but in all written statements put out by the issuer. So that's also something that we'd be looking at.
Thanks. Let's see here. Maybe for Oliver, there's two questions really in relation to the listed issuer financing exemption. So that exemption is kind of a hybrid between using, instead of having to do a full prospectus and all the costs and disclosure associated with that, relying on your continuous disclosure, but you get free trading shares just like you would with using a prospectus. So there's two questions. One is, are there other advantages other than the fact that you get those free trading securities? You don't have the full 4-month hold period that you'd sort of identify. I guess I sort of mentioned there's less of the costs than you'd have with a prospectus. And then the other question is, with a prospectus, we are required before we issue a receipt to consider whether the company's got sufficient funds. And so that same requirement exists with the listed issuer financing exemption, or a very similar requirement anyway. So if you could speak a bit about additional sources of what sort of additional sources of funding can be included other than what's being raised in the life exemption.
Absolutely. So just talking about the advantages for an issuer. So as Denise previously mentioned, the lower costs, but also not the life exemption isn't subject to an initial review by the ASC. That just allows the issuer to hit the ground running faster. That's probably the biggest advantage for the issuer. Going back to the kind of assessment of available funds. So CSA staff notice 4533, the frequently asked questions of life, states that additional funding must be committed to be considered. So for example, allowable items include a concurrent bought deal, a concurrent bought deal private placement or an available credit facility. So in situations where an issuer was to include any funding that is not fully committed, we may require them to increase the minimum offering through our review.
Thanks, Oliver. Okay, there's another question here. I'm not sure who wants to take this one. I think the question is, okay, if there's a resignation of an officer or director, what needs to be filed? So news release, material change report. Got any takers?
I can jump in, Denise.
Okay.
So I think this one is really it depends. Like, it depends on the issuer. You have to look at the facts and circumstances for the particular issuer. Like, if you were to look at the definition of material change in the Securities Act, it refers to, I'm just actually going to read it out. I pulled it up. A change in the business or probable change, business operations or capital of the issuer that would reasonably be expected to have a significant effect on the market price or value of a security of the issuer. So for one issuer, that might be a material change, and for another issuer, it might not. Where we do more commonly see it filed is for like a CEO or a CFO or a lead director, maybe, but not always.
All right. Let's see here. I think we've answered all of those. Are any others pending that I haven't gotten to? Chris, I think there's something here that's for you. Okay, so we recently completed an acquisition where we issued shares as consideration to acquire a company developing a complementary technology. If that would be complementary to our products. We think the technology is valuable and will be worth much, much more when it's commercialized. So why would staff have concerns with the value that has been recorded for the shares that are issued in those circumstances?
Yeah, for sure. Thanks, Denise. So IFRS 2 would detail that fair value is measured at the date the entity obtains the goods or a counterparty renders the services. So it's generally not appropriate to record it based on what management believes it may be worth in the future when it's fully commercialized based on the shares issued, as generally they've acquired an intangible asset, a product in development, which is recorded at its cost based under IAS 38, intangible asset standard. So we would generally believe that the cost base under IAS 38 is reflective of the fair value at the date of acquisition.
Great. Okay, I don't see any more questions here. So we might give you back some time in your day. I just mentioned for the audience that, did I miss anything? Are there any questions, you guys? Okay, so we'll just mention that the recording of this webinar will be available on our website, as well as the slides. Both of those will be available on the in the presentation section of our website. If you think of a question afterwards that you want to ask, please feel free to reach out to us. If you have any suggestions for future sessions of this event or others, we're very interested in hearing that as well. We are continuing to try and build out resources for reporting issuers, and we are developing a series of little short videos that should be within the coming months available in the Issuer Toolkit section of our website. So Anthony's team, the folks on the screen here, they've been doing various sort of introductory videos on continuous disclosure. We have other teams working on things like filing insider reports or reports of exempt distribution. So stay tuned for that. And so I think that's it for this morning. Thank you very much for joining us. And again, please feel free to reach out if you have any questions. Thanks.